Your strategy is fine. Your entries are clean. Your backtest results checks out. Here's what nobody tells you. Profitable strategies blows accounts every single day. Not because the strategy stopped working, but because of something happening underneath it that most traders never think to look at it. Comment below if you have a strategy that works in backtesting but keeps falling apart in live trading. Because what I'm about to show you is almost certainly the reason why. I want to be upfront about why I can speak on this. I've blown funded accounts. I have failed challenges. I have no business failing. And for the longest time, I kept pointing at my strategy, my entries, my timing. I kept thinking the problem was somewhere in the setup. It was not. After collecting over 3,000 backtested trades across 10 months, I started seeing something in my data I could not unsee. My worst periods had almost nothing to do with bad setups. They had everything to do with how I was managing risk underneath those setups. My risk was never as clean as I thought it was. Later in this video, I'm going to show you exactly how to audit your risk exposure so you can see what is actually happening in your account. But first, you need to understand why most traders are over-risking without even realizing. So let us talk about the 1% rule. Most traders treat this like a golden standard. Risk 1% per trade, stay consistent, and you are protected. And on the surface, that logic holds up. But the problem is that most traders are only looking at one dimension of risk when there are actually several working against them at the same time. The first one is correlated position. If you are trading two pairs that move together, say two open trades on Seagate and Micron, both are in the semiconductor industry, you are not risking 1% on two trade ideas. You are effectively risking 2% on the same idea. The market does not care that you open two separate orders. If the market moves against you, both trades move against you simultaneously. Your actual exposure is doubled and you did not even notice that. The second one is revenge sizing. This one is subtle, but it is extremely common. After a loss, the emotional pull to recover quickly is strong. So without consciously deciding to, you start sizing slightly larger on the next trade. Not dramatically larger, just enough that it does not feel like a violation. But over a long sequence of trade following a loss, that sizing creeps compounds. And now you're not risking 1%. You're risking maybe 1.2%, maybe 1.5%, or even 2% at exactly the moment where your emotional state is least equipped to handle another loss. The third one is trading low quality setup with full risk. If your backtested data shows that certain setups have a significantly lower expected value than others, applying the same position size to both is not consistent risk management. It is actually inconsistent risk management disguised as consistency. You are giving the same weight to a high conviction setup and a borderline setup, and that dilutes your edge over time. Think about it like a poker player, a professional like Phil Ivey, who does not bet the same amount every hand, regardless of what he is holding. He sizes his bet based on the strength of his position. When the hand is strong, he commits more. When it is marginal, he protects his stack. Trading works exactly the same way. Your bet sizing should reflect the quality of what you are holding, not just the fact that you are at the table. When you add all these correlated positions, emotional sizing, and undifferentiated setup quality, your real risk exposure on any given day can be 2 or 3 times what you think it is. And you will never know unless you were tracking it. Now, here's a reframe that I think is going to hit differently for a lot of you. Most trading contents treat psychology and risk management as two completely separate topics. Mindset over here, position sizing over there. But in my experience and in my data, they are not separate at all. Almost every emotional trading mistake I've ever made was downstream of excessive risk. Think about it this way. When you're oversized on a trade, what happens? Your heart rate goes up, you start watching every tick, you move your stop loss because the drawdown feels unbearable. You close early because the profit feels too good to give back. You revenge trade because the loss felt catastrophic. None of that is a psychology problem at its roots. It is a risk problem expressing itself as a psychology problem. The fear you feel when a trade goes against you is proportional to how you have at stake. Reduce the stake to a level your nervous system can really handle, and the emotional interference drops dramatically. In my own trading, I found that my rule breaking spiked in a very specific context. After 3 consecutive losses, my execution quality dropped significantly. Not because I suddenly became undisciplined, but because 3 consecutive losses at a full size create enough emotional pressure that my decision making shifted. Once I identified that pattern in my data and built a rule around it, the problem became manageable. I was addressing the actual cause, not the symptom. Comment below if you have ever noticed that your emotional trading gets worse after a losing streak, because that pattern is not a coincidence and it is not a character flaw. It is a measurable, predictable response to excessive risk exposure. But before I show you how to fix your risk framework, there's something crucial you need to understand about what poor risk management is actually costing you, because most traders are only counting the financial loss, and that is only half the picture. When most traders think about the cost of poor risk management, they think about the dollar lost on bad trades. And yes, that is real. But the cost that nobody talks about is what it does to your confidence, your decision making, and your ability to execute over time. Every time you take an oversized loss, you're not just losing money, you are losing trust in yourself. And that trust is incredibly hard to rebuild. It's what causes traders to hesitate on perfectly valid setups. It is what causes strategy hopping, where you abandon a system that actually works because one bad drawdown shook your confidence. It's what causes the cycle of starting over, finding a new strategy, building some confidence, blowing it up emotionally, and repeating the cycle again. I went through this cycle multiple times before I understood what was actually driving it. And when I look back at those periods, the common thing was never the strategy. The strategy was fine. The common thing was that I was carrying more risk than my psychology could sustain, and it was eroding my execution from the inside out. There is also the cognitive cost. When you're overexposed to a trade, your mental bandwidth is consumed by that one position. You're not thinking clearly about the next setup. You're just trying to survive the current one. And that cognitive drains compounds across a session in ways that are almost impossible to measure but very easy to feel. Here's something that took me a long time to accept, and I say accept deliberately because intellectually I understood it much earlier than I was willing to act on it. Position sizing matters more than your entry. Now, most retail traders obsessed over entries, the perfect entries, the cleanest set, the ideal risk to reward ratio on paper. And I get it. Entries feel like the skill. They feel like the thing that separates a good trader from a bad one, but the data tells a different story. A bad entry with correct sizing can be managed. You can move your stop loss to break even, take partial, reduce your exposure as the trade develops. But a good entry with incorrect sizing will destroy you emotionally before the trade even has a chance to play out. Because the moment it goes into drawdown, even temporarily, the pressure becomes unbearable and you make a decision you would never make if the size were appropriate. In my own data, my maximum drawdown is at 8.13%. That number did not happen by accident. It happened because I built rules around sizing that were designed to keep my exposure within a range my psychology could handle across a sequence of trades, not just on any single trade. My win rate is only 19%, but My average risk to reward sits at 6R. That combination only works if the sizing is disciplined enough to survive the losing sequences that are statistically guaranteed to happen. This is probably the most emotional, painful part of trading for most people. You have a losing streak, 3 losses in a row, 4, 5, or maybe 6. And the voice in your head starts asking whether the strategy actually works, whether you should change something, whether you have been fooling yourself this whole time. And almost every trader I've spoken to has responded to that voice by doing something, changing the entries, tightening their criteria, switching time frames, and in doing so, they abandoned the very edge they spent months building right before it was about to pay off. Here's the truth about drawdowns. They are not a signal. They are statistically inevitability. With a 19% win rate, I'm losing 8 out of every 10 trades on average. That means losing streaks are not just possible, they are expected. And they are part of the system working correctly. The question is never whether a drawdown is happening. The question is whether your trades during that drawdown are still in line with your system. That is the only question that matters. Are you executing correctly? If yes, you stay the course. If no, you investigate why. But you do not change the system based on a losing streak alone. Because if you do, you're not trading a system anymore. You are trading your emotions. This is why risk management is not just about protecting your capital. It's about protecting your ability to stay in the game long enough for your edge to compound. A 50% drawdown requires a 100% gain just to get back to where you started. Most traders never recover from that mathematically or psychologically. The main goal is never to get there in the first place. I want to close with something that goes a little deeper than tactics, because I think the reason most traders struggles with risk management long term is not that they do not know the rules. It is that they have not made those rules part of who they are as a trader. Good traders do not think about risk management as a constraint. They think about it as the thing that keeps them alive long enough for their edge to matter. The question they ask is not about how much they can make on this trade. It is, how do I survive long enough for my edge to compound across hundreds of trades? That shifts from someone chasing the next win to someone protecting their ability to keep playing is what separates traders who last from traders who do not. I have been on both sides of that line, and the difference in how it feels to trade from each side is enormous. When I finally internalized that any single trade is statistically irrelevant to my long-term result, the pressure dissolved. Not because I stopped caring, but because I had 3,000 data points telling me that the process worked if I protect it. Everything I walk you through today, tracking your real risk exposure, identifying your emotional triggers in your data, sizing correctly across different setup qualities, all of it requires one thing: a structured place to record and review it. The free trading journal I built and use myself has all this built in. It is the exact structure I use to collect my 3,000 backtested trades, identify my deviation pattern, and build the rules that protect my execution. Link in the description below. Drop a comment below and let me know which part of this hits hardest for you. Was it the part about correlated position, the emotional cost of oversizing, or the identity shift at the end? I read every single comment and I use them to shape what I cover next. If this gives you value, make sure you're subscribed, because I am documenting this entire journey, the wins, the losses, the data, all of it. And if you're serious about fixing your risk at the foundation level, the next thing you need to understand is why most traders are actually sabotaging their own backtesting process before they even get to live trading. I did a full breakdown on exactly how to fix that. Watch the video here.